Have you ever wondered why so many beginners blow up their accounts trying options trading, thinking it's just a fancy way to gamble? Alright, let's break this down today. I'm going to explain options trading in a super simple way, using something everyone knows, dice. Yeah, those little cubes you roll in board games. By the end of this video, you'll get how options work, why they're not pure luck like some people say, and how you can use them without losing your shirt. We'll go through the basics step by step with examples that make sense. So even if you've never traded before, you'll walk away feeling confident. The big issue here is that options trading looks scary and complicated at first. Most people hear terms like calls and puts and just freeze up. They think it's only for Wall Street pros with fancy degrees, or worse, they jump in blind and end up losing money fast because they don't understand the risks. I've seen friends try it after watching some hype video, buy a bunch of cheap options hoping for a moonshot, and then watch them expire worthless. It's frustrating, right? That confusion stops a lot of folks from building real wealth through trading, or it leads them to stick with boring stocks that barely move. But the truth is, once you grasp the core ideas, options can be a powerful tool to make money whether the market goes up, down, or sideways. The challenge is cutting through the jargon and seeing it for what it is, a game of probabilities, kind of like deciding whether to bet on a dice roll. So, let's start exploring this with our dice analogy. Imagine you're at a table with a standard six-sided die. You roll it, and the number that comes up decides if you win or lose a bet. Options trading is similar because it's all about predicting outcomes with a bit of risk and reward built in. But unlike a straight bet where you might just wager on even or odd, options give you more control over how much you risk and what you could gain. First off, what's an option anyway? It's basically a contract that gives you the right, but not the obligation, to buy or sell something like a stock at a specific price by a certain date. Think of it as buying insurance or making a side bet on where the price will go. There are two main types, calls and puts. Let's tackle calls first. A call option is like betting that the die will roll high, say a 4, 5, or 6. If you're right, you win big. If not, you lose what you paid to play. In trading terms, when you buy a call, you're betting the stock price will go up above a certain level called the strike price before the expiration date. For example, suppose Apple stock is at $150 right now. You could buy a call option with a strike of $160 that expires in a month. That option might cost you $5 per share. Since options usually cover 100 shares, that's $500 total out of pocket. If Apple's price shoots up to $170 by expiration, your option lets you buy the stock at $160. So you make $10 per share profit minus the $5 you paid, netting $5 per share or $500 on your investment. But if the stock stays below $160, the option expires worthless and you lose that $500. See how it's like rolling dice? The die has equal chances for each number, but in stocks, news, earnings, or market mood can tilt the odds. Now, to make this dice thing clearer, picture this scenario. You're playing a game where you pay $1 to bet on the die showing 5 or 6. If it does, you get $3 back, so you profit $2. If it's 1 through 4, you lose your $1. That's a call option vibe. Limited risk, just the premium you pay, but unlimited upside if the stock rockets way past the strike. In real life, I've used calls on tech stocks during earnings season. Like back when Tesla was hovering around $200, and I bought calls betting it'd jump after a good report. It did, and that trade turned $1,000 into $4,000 in a week. But I've also lost on calls when the market dipped unexpectedly, like during a surprise interest rate hike. The key is understanding the probability dice have fixed odds, 1 in 6 for each face, but stocks. You look at charts, trends, and volatility to guess better. Shifting to puts, these are the opposite. A put option is like betting the die will roll low 1, 2, or 3. You're predicting the stock will drop below the strike price. Using the Apple example again, if the stock's at $150, you might buy a put with a $140 strike for $4 per share or $400 total. If Apple falls to $130, you can sell at $140, making $10 per share minus the $4 cost, so $6 profit per share or $600. But if it stays above $140, buy $400. Puts are great for protection, like hedging your portfolio. Imagine you own a bunch of stocks and you're worried about a crash, you buy puts as insurance. If the market tanks, the puts pay off big, covering your losses. It's like in dice. If you bet against high rolls during a streak of bad luck, you clean up. But let's develop this analogy more because options aren't just about direction. There's time and volatility too. In dice terms, the expiration date is like having a timer on your bet. You have to roll within 30 seconds, or it doesn't count. Options lose value over time, called theta decay, so shorter-term ones are cheaper but riskier, like a quick roll. Longer ones cost more but give the stock time to move. Volatility is the shake. If the die is volatile, maybe it's weighted or the table's bumpy, making outcomes wilder. High volatility in stocks pumps up option prices because big swings mean higher chances of hitting your strike. Another layer, you can sell options too, not just buy. Selling a call is like being the house in a dice game. You collect the premium up front but have to pay out if the buyer wins. Risky because if the stock explodes, your losses could be huge. I once sold puts on a stable stock like Coca-Cola, thinking it wouldn't drop much. Collected a nice premium, and when it stayed flat, I kept the money. But sell at the wrong time and ouch. Now, for the real eye-opener moment, let's tie it all together with a full example using dice to simulate a trade. Suppose we have a stock called Dice Corp at $10. You think it'll go up, so you buy a call with $11 strike, expiring soon, for 50 cents premium. That's like paying 50 cents to bet the next die roll, representing the stock move, is over 3. If it rolls 4 to 6 stock up, you exercise and profit. But add an implied volatility. If the market's calm, premium's low. If shaky, it's high. Here's where it clicks, options let you leverage. With $50, you control 100 shares worth $1,000. A 10% stock move could double your money or wipe it out. That's the climax. Realizing options amplify gains and losses. So start small, use stop losses, and never risk more than 1 to 2% of your account per trade. I learned this the hard way early on, turning a $200 loss into a lesson that saved me thousands later. Wrapping it up, options trading boils down to smart bets on price moves, with calls for ups and puts for downs, all while managing time and volatility. Using dice helps see the probabilities without the overwhelm. Remember, it's not gambling if you study the odds, check charts, news, and use paper trading to practice first. Once you get it, you can make consistent money, even in flat markets, by selling options. Check the video description for help and recommendation. Hit that subscribe button for more trading tips like this.